recovery against the pre-COVID base of FY20. Consolidated revenue from operations in Q1 at 48% of Q1 FY20 revenues, primarily led by the growth in our delivery business. Our dining segment also reported stronger recovery at 22% against nearly 3% recovery in Q1 FY21 during the first wave. We continue to operate under strict supply side restrictions like 50% capacity utilization, restrictions on operational hours, primarily dinner timings and weekend lockdowns, etc. These restrictions are slowly easing, and the pace of recovery post the second wave has been much faster than the previous lockdowns. In the month of July, our consolidated revenues were 86% of corresponding pre-COVID month of FY20. With increase in revenues from our dining segment in July, the momentum from delivery has been maintained, and this reinforces our belief that our delivery offering is allowing us to significantly leverage our assets by opening up an incremental business opportunity. Our reported EBITDA loss was rupees 104 million versus a loss of rupees 208 million in Q1 FY21. With focus on cost optimizations, we have reduced our operating expenses by 33% this quarter compared to the previous quarter. We also continue to remain focused on investment in our own digital platforms covering reservations, delivery and loyalty. The share of business coming from our own digital platforms was 21.2% as on Q1 FY22. Specifically, the share of delivery business from our own app has increased from 3% in Q1 FY21 to 17% in Q1 FY22, led by our focus on building and growing our digital assets. We have also restarted our network expansion and added 2 new Barbeque Nation restaurants in Q1. An additional 8 Barbeque Nation restaurants are under construction, and we have a strong pipeline of future projects. With our focus on delivery, we also intend to increase our points of sale through extension kitchens so that we can reach closer to our customers and provide them with enhanced product experience. With this backdrop, we launched 4 extension kitchens across 3 cities in July. As Kari mentioned, last year we saw Barbeque Nation transform and evolve to the needs of the customers. We are now gradually shifting to being a food services company with diversified offerings. We are constantly evaluating new growth areas and are very optimistic about the structural changes in the business which are playing out as things normalize. We remain committed to our employees and are extremely happy and proud that we have successfully vaccinated all our restaurant employees across all locations with at least 1 dose. And we'll continue to drive this with the second wave as per the prescribed timelines. With this, I'll now open the floor for the interactive Q&A session. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. The first question is from the line of Sushmit Patoria from Motilal Oswal. Please go ahead.
Hi, good evening, Rahul. Congratulations to you and the team. Rahul, my first question is, you mentioned in your presentation that operating costs will be 33% lower than Q4 FY21. So if just to kind of clarify that, Q4 FY21 operating cost that you're referring to is 100 crores. Is that the number, which is...
Sushmit, the way we have calculated is that we have looked at our operating EBITDA and the reported gross margin. The reported EBITDA and the reported gross margin, and the difference between the two is what we compared between Q4 and Q1. And one other thing that we adjusted is the variable cost of the delivery business, which is primarily commissions and packaging cost. So if you look at primarily the balance cost left, which are largely fixed costs, which again are mostly employees, some other operating costs and rental costs. So those on an absolute basis has come down by 33%.
And you think that will remain lower by 33% for the full year, correct?
No. So some of these obviously as we ramp up our dining business, we'll also have to ramp up our some of our employee base, and there's also some waivers that you could get for Q1, which might just come back. So this is, I think, purely cost optimization during a tough quarter that we had in Q1.
Okay, got it. And my next question, Rahul, is on you also mentioned diversified menu options to provide multiple cuisines. So is this something new which is beyond the barbecue in a box and Toscana?
No, right now it is only these two, but specifically on both Barbeque in a box and Toscano. In Barbeque in a box, we have also added a couple of more variants to our box offering. Specifically, we launched something called Overload non-veg box and my biryani and kebab box, which has done well. And on Toscano side, specifically on delivery, the business has been doing very good. Almost 34% of the business came from delivery in Toscano.
So it's not like you want to add any new cuisine, correct?
No. Not currently.
Yeah. And last question from me, I'll get back in the queue. Rahul, is how are the economics now settling for delivery? Because it looks like in this quarter, it looks like the gross margins are lower, but EBITDA margin may not be very different from the usual run business. So if you can just...
So on the delivery side, one, your contribution margin as compared to dine-in is lower, right? Because you have two other variants, which is packaging and commissions that you pay to aggregators and the last is logistic cost, right? So that's one. The food cost between delivery and dine-in is not significantly different. Delivery may be slightly higher, and that's by design because we currently want to ensure that the product which is being sold is of great value to our guests. I think the gross margin decline that we saw in quarter 1 versus quarter 4 of last year is predominantly because of our reduction in margin from our dine-in business. And that's also because since the dine-in business is not yet operating at an optimal capacity, your utilization of buffets, for example, is not that great. Secondly, dine-in is right now happening mostly during weekdays and not during dinners or weekends, which are high realization price points for you, and because of which your gross margin is slightly lower. So coming back to your original question of delivery economics, I think with the increase in sales, we are now pretty confident that whatever average daily revenue we are doing, and that's the reason why we also ventured out on extension kitchens, that at these sales number and these contribution margins, and after paying off some additional cost of say rentals or electricity and manpower in these extension kitchens, we would be definitely doing early double digit EBITDA margins, which obviously will improve as your sales further go up. So that's the way economics is working out on delivery.
Got it. So just to clarify, you're saying double-digit EBITDA margins on even the standalone extension counters for delivery, correct?
Yes.
Got it. Okay. Thanks, Rahul. I'll get back in the queue.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. The next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Yeah, sir. In the new scheme of things, with the delivery, what is the throughput per store which we should look at, when it's a fairly normal business environment? And how does that throughput per store change vis-a-vis earlier?
So, look, there are a lot of, noise in numbers because at some times you only delivery and don't have dine-in. But if I look at only quarter 1 performance, we had delivered around 56 crores of delivery revenues on a base of approximately 160 outlets doing that, which translates to, I think, broadly some 12.5 lakh rupees of monthly numbers, which is approximately 1.5 crores of delivery business. Now, our dine-in business, pre-pandemic, on average, we used to do approximately 6 crores of revenue per outlet. And now, as our delivery is scaling up, which has done well during quarter 4 last year, it has done even better in quarter 1 this year, but our dine-in business was not there. So I think we'll have to wait for the normalized period. But my belief is that once situation normalizes, I don't see any reason why dine-in will not come back to its original base. And delivery, as we'd always maintained, that is an incremental business for us. And this was also reinforced in the month of July, when despite the fact that our dine-in started to pick up, our deliveries, we didn't see it going down. So I think overall, in a normalized scenario, my belief is that both dine and delivery should play well.
So we head to something like 7.5 crore per store. At that level, what should be the EBITDA margin of at the company level pre-Ind AS?
So, look, it's all futuristic right now, but if you look at our pre-pandemic EBITDA margins on dine-in business, at store level, we used to do around 21-22%, and on incremental delivery business, we do around similar margins. So overall, its store level margins on a percentage number should be same 21-22%, and then your back-end cost, which is around 5 to 6. Now, on larger base, it might tend towards 5 then 6. So blended margins, should come to around 15%.
Okay. And sir, I couldn't understand your kitchens which you were talking about in 3 cities. So is that we are now incrementally also setting up cloud kitchens in 30 cities, which is what you were hinting at?
Yes. So the reason for doing this is that if you look at our larger markets, metro cities like Delhi, Bombay, Bangalore, and these larger metro cities, we are only doing delivery from our Barbeque Nation kitchens, which is a less number in these cities, right? So Bombay, for example, has around 15 outlets only, and which restricts our capability to serve a larger market in this metro market where demand is higher. So what we are doing is setting up small extension kitchens, which is going closer to your customer, so that one, their customer experience also will be better, and your delivery outreach will go higher. These will always be linked to one mother kitchen, and as of now we have 4 which are launched. We'll watch the performance. We'll see what are the challenges on the ground, and then based on that, decide on taking it up forward in future.
So these 4 kitchens have been launched in the 4 metro cities, including Bombay, is what you have started with?
Yes. So there are 3 cities, but one is Bombay, yeah.
And what is the capex that you have put in these kitchens?
These are broadly 1/10 of what we put in Barbeque Nation outlet overall. So around 25 to 30 lakh rupees per kitchen.
Okay. Does it also mean that some of the delivery business from the store gets serviced from these kitchens? So if I am not double counting.
No. So I guess this is planned in a manner that you don't over cannibalize your existing business from the existing dining outlet. So the idea is to reach a wider set of your target customers.
Okay. And my last question is, you mentioned that we have started with store additions. You added 2 in the Q1. So incrementally, what is our store addition plan, and do we need to revisit any of the existing stores?
So we targeted to open 20 outlets this year, out of which we could only open 2 because also Q1 was mostly pandemic period. Post that, we have a strong pipeline of under construction projects. I guess based on how we also convert the balanced pipeline of sites, we might revisit our targets. But as we've always maintained, what we look for in site is the market potential and the rental deals that are coming through. As long as it looks attractive, we will do that.
Okay. Just a clarification. You mentioned that earlier format of your business operations got at about 15% EBITDA margin when delivery was not so prevalent. And now when you're adding about 1.5 crore of throughput on the existing store, it means that the incremental 1.5 crore gross profit should flow down to your EBITDA. Is that the assessment correct? And what is the differential contribution margin between dine-in and delivery? So when I say contribution, so obviously in delivery we need to then consider the RM costs, commissions, and the delivery costs. Whereas in case of dine-in, it will include the store OPEX cost, which is variable, and the RM cost. So what is the differential there?
So our blended gross margin last quarter, when we had full dine-in operational practically, was around 67%. Pre-pandemic, also we used to do a gross margin of around 66%. On the food cost side, I don't see much difference. The other two, commissions and packaging costs, is incrementally added to that. But overall, at a blended level, we should still maintain a 21% store level margins in those restaurants.
Despite 6 crore throughput going to 7.5?
Yes, because as you rightly said, the contribution margin, plus when you are doing delivery, you would also need to, and with scaled up delivery business, you also need to add few more employees so that we get the dedicated focus and deliver a product which is up to the mark for the customer experience.
Okay. Thank you very much, sir, and all the best.
Thank you.
Thank you. Any participants who wish to ask a question, please press star and 1. The next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, Rahul. Just wanted to understand, adjusted for Ind AS accounting, what would be the margins of the international business this quarter?
So we have maintained double-digit EBITDA margins there also in international business this quarter also.
Okay, and same thing, if you can give an idea for Toscano, how much would be the, rather than margins, the absolute rupees million loss or something?
We had, so the business is small right now. I think we had broadly 1.5 to around 1.75 crore loss at EBITDA level. That's also because, like our India business, a large part of their dining business was closed. And on delivery business, they also grew pretty much in line with what we have done at Barbeque Nation.
Right. And another question I had was, see, you're opening these extension kitchens, which will be for delivery. But any thoughts on having a delivery come dine-in business, which is not a proper full 90-minute lunch or dinner kind of occasion, but if someone just wants to have a snack, maybe a plate of kebabs, something like that, to open a very sort of small square feet, let's say 1,000 square feet kind of place, which will have maybe 15, 20, 25 seaters who can just come and have a snack, sort of a QSR kind of take on the Indian cuisine. Have you given any thought on some format like that?
So, Percy, yes, we keep looking at various formats. And I think that's the evaluation of UBQ, that's the evaluation of Barbeque in a Box, and we keep evaluating few of them. But some of them are really early stage to I think talk to this group. Like last time also, we mentioned we might look at extension kitchens, and we were constantly evaluating that the economics and this quarter, since we launched 4, we just came out and put that. But yes, we are evaluating something like that, but it is still work in progress, and we don't know when this will come out because it is still not in a format that we can go ahead and launch something.
Sure. Next question I had is, see, pre-pandemic you had a 6 crore kind of dine-in sale. Now, as you open more stores, obviously for any retail format, any restaurant format, the early stores will be the cream of the opportunity, which will have very high sales per store, etc. And as you then open newer stores, maybe you are going a little bit down the ladder in terms of opportunity. That's what I think. I don't know. You can correct me if my thought process is wrong. So what I'm trying to ask is, after the COVID situation is fully normal, and let's say you add another 50-60 stores over the next 2 years, do you think that your dine-in component on a sales dine-in sales per store will come back to the 6 crore level? Or do you think it will be lower than that, but your overall sales per store will still be higher because of the addition of delivery?
So let's look at dine-in separately first. We have always maintained that the opportunity of more dine-in stores in metro markets are still very large. Like also places like Delhi, Bombay, Bangalore, all these are less than 15 or 20 outlets in these cities, and this can grow further. And if you look at our current pipeline, so between the 2 that we opened in Q1 and the 8 that we are under construction, I would say 7 of these are in metro and tier 1 markets. Right now, 3 are in tier 2, tier 3 markets. So, and advantage of these larger markets is that your brand is known and the maturity profile of these outlets are faster. That's one. Secondly, if you look at our growth in number of outlets just before the pandemic, last 3 years, you'll see that almost 40% of the outlets are less than 3 years old, right? And those themselves are not matured to a larger extent. And then pandemic happened, so that story is not playing out, right? But overall, my belief is that a 6 crore average number, I think, should not come down post-pandemic. And to some extent, I think if there's also a push from the industry about growth in dine-in post-pandemic, that also should help us. So at least post this current situation, I don't see any reason why for at least couple of years we should worry about average coming down on pure dine-in business, and then obviously delivery is incremental for us.
Sure. So what you're saying is that once the disruptions are completely 100% gone, then your dine-in will revert to a 6 crore per store kind of a number.
Yes, it should. I don't see any reason why it should not.
Okay. Yeah, that's all from me. Thanks, Rahul, and all the best.
Thank you, Percy.
Thank you. Our next question is from the line of Parikshit Shah from Zero Capital. Please go ahead.
Yeah, hi Rahul. Just continuing on the previous question on the dine-in outlets, you mentioned that there is enough potential in metro tier 1s where bulk of the stores are still being constructed. And earlier you also spoke about you're going to wait and watch on these extension kitchens, the 4 that you've built so far. I'm just wondering, longer term, does the success...
The person you are speaking with has put your call on hold.
Hello?
Yes,
go ahead.
I can hear you.
Yeah. No, I was just wondering, so longer term, would the success of the extension kitchen sort of tone down your store addition ambition? I'm just wondering if, is there a path where you decide to go down one path rather than the other, or are they always going to be coexisting, that there will always need to be X number of dine-in outlets needed to support certain extension kitchens?
So my belief is that it should coexist because the dine-in outlets are primarily serving the dine-in and the celebration need of our guests, which is our core, brand, and also a very strong brand which attracts, I think, good footfall. So we will continue to do a dine-in, and if in a particular area dine-in has a potential, we'll do that, even though we have, say, an extension kitchen which is within 1 kilometer of that radius. So I think both are different target markets. If delivery was not there, then our dine-in business still had very strong return profiles, pre-pandemic, right? So we evaluate a new site based on the potential of the dine business, and if that can also become an additional point of sale for delivery business, that's anyway incremental, right? And the delivery business is then evaluated on the merit of what is the demand that I'm projecting in that particular trade area, and do we have enough points to service that. So we are not thinking in terms of if there is extension kitchen, don't open dine-in, or if there's dine-in, don't open extension kitchen. No, it all depends upon what is the current capacity. Are you able to service your guests better, and can you extend your radius in that particular trade area and service more and have 1 or 2 extension kitchen rather than just relying it from your main dining business.
Okay, fair enough. And the other question I had, I think in your opening comments you mentioned the delivery from your own app has gone up to 17% versus 3%, I think a year ago, if I'm not wrong, if I got the numbers right. Just wondering how are you driving this? Is there is there a pricing differential if one were to order from your own app versus the aggregators? Is there more discounting? Just wondering, what you're doing to drive this, because obviously this will be very critical to the margin profile of the delivery business.
Yes, so it has gone up from 3 to 17. You got that right. No, the pricing is not different between the 2 platforms. The only thing that we don't do in our platform is we don't charge delivery fee, which some of the aggregators charge, but that's small. what we are seeing is that our previous strategy of a dine-in customer earning loyalty points, smile points, and then redeeming on delivery is playing out pretty well. And we are seeing a large number of redemption on our own platform, which will also have smile redemptions, right? And that is something which is our own core customers, and the repeat numbers in our own app is also very strong. Yes, we did mention this number of 3 and 17, but we have to still see how this stabilizes, because the delivery business is still growing at a really fast pace, right? And the numbers that are coming is also driven by, I would say, industry numbers growing, while our numbers are I'm assuming better than industry. But I would wait for some more time to see how they stabilize and not jump into saying that our own, own app businesses has a far superior margin profile. I think the focus right now is to ensure that your guests, your customers like your product, and you tap that Indian cuisine market that you always wanted to tap on the delivery side, right? And in that situation, even if your margins are a couple of percentage points here or there, it's okay for a time being, right? So that's the broad thought that we have. But to keep it short, I think we're extremely happy with the way our guests and our customers have adopted our own app, right? And now we are also thinking about how do we further invest in scaling up our digital capabilities.
Okay, fair enough. Thanks a lot and good luck.
Thank you.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal. Please go ahead.
Hi, thanks for letting me ask questions again. First question, Rahul, is any premium properties that you've been able to bag in this last few months?
So by premium, you mean high rental properties that has now?
Yeah. Let's say BKC or those kind of premium.
Yes, we have a couple of sites in Bombay which otherwise were not making sense in terms of rentals.
Right. So you were able to get them?
Yes, they're under construction right now.
Oh, great. All right. The second is, could you tell us how much was the cash burn in quarter one?
So, adjusted for Ind AS, we had consolidated cash burn of around 35 crores.
35 crores. Okay. And just my last question, Rahul, is one of the things that I had raised earlier as well. There is a significant difference in the Zomato rating of Barbeque Nation delivery and dining in a few, whenever you open a few restaurants. Any thoughts on that? Like, for example, in some restaurants, the difference is as much as 3.5 and 4.5. So, can that dilute the brand? Have you thought about this?
So certainly, yes, we have thought about it. Our dine-in is, I would say, a 15-year-old brand, and we have maintained that excitement, customer excitement, and stabilized at 4.5. On delivery side, I would say it's almost large part of business comes from Barbeque in a Box, which is just a 1-year-old product, and we are constantly improving on that. And we're also seeing that reflected in our ratings. So at a blended level, our ratings, which were approximately I would say 3.4 6-8 months back, is now trending towards 3.8. So there is gradual improvement happening on that, and at the back end also we are constantly working on menu rationalization. Some products which don't do well on delivery, some which we are changing our packaging at times. So those are constantly happening, and the way despite the business increasing by almost 7-8x over these 8-9 months, our ratings have only improved, right? So that gives me a lot of comfort.
Okay, got it. Thank you. Thanks again.
Thanks, Smith.
Thank you. Participants, please press star and 1 if you wish to ask a question. The next question is from the line of Deepak as an individual investor. Please go ahead.
Yeah.
Deepak, your line is unmuted. Please go ahead.
Yeah. Good evening, sir. Thanks for the opportunity. My question is around the delivery business. What is the average ticket size of delivery, sir?
You mean the average transaction size?
Yes, right.
Yeah. So it's approximately 650 rupees.
650.
Yeah.
Okay, and my second question is around on partnering with some other apps such as PhonePe or Zomato. If you see in Zomato, Barbeque is promoting their stores or delivery. So is there any strategic tie-up planning or anything in pipeline?
So it's a continuous, dialogue and discussions that we keep having with our educator partners, and based on various considerations of marketing budgets, their own availability of space in their app, our marketing team keep promoting those offers there.
Okay, sir. And my last question is around the cloud kitchen. So for cloud kitchen, what is the average, monthly revenue you are expecting from cloud kitchens?
So, Deepak, it's very young. We just started in the month of July, and
Yes,
I would say if you look at the average sale of each restaurant, it is approximately 12 lakh rupees based on the existing kitchens that we're doing. So let's see how it evolves. But right now it's early to commit on what numbers we are looking at on cloud kitchens.
Okay, thank you so much, sir, and best wishes.
Thank you, Deepak.
Thank you. Our next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yes, sir. Thank you. I have a follow-up question. After putting up the capex for 2.7 crore per store, what is the replacement needs or maintenance needs of the store? And if you could give us how is that maintenance need being spent out or accounted in the P&L or balance sheet?
So there are some regular maintenance that which like AMC costs and all, which gets charged to the P&L cost. And if there are any capex items like replacement of any kitchen equipment or replacement of any AC equipment, which is capital in nature, then that gets capitalized in our business. And typically we have seen that on an average we spend almost 5 lakh rupees per outlet per year, blended in the company for maintenance related capex work.
And that's accounted in the P&L?
No, this is capex related, which is balance sheet.
So you spend 5 lakh rupees?
So for 100 outlets, you would spend approximately 5 crores a year.
Yeah. So on per outlet basis, 5 lakh rupees is spent every year and that is capitalized?
Yes.
And do we have, so this kitchen equipment which comes, let's say, once in, so any major overhauling of the store which comes, let's say, once in 7-8 years, or it's a regular 5 lakh which is sufficient enough for the life of the store?
Oh, 5 is sufficient, and that's what we have looked at our data based on last 5-6 years. Also, what happens is it all depends on how much is the utilization of that store, right? So our high performing stores, might need some higher maintenance, but some of the low throughput stores would need lower maintenance. But blended numbers that I'm giving you is the overall portfolio number based on experience in the past.
And this includes the kitchen equipment change also?
Yeah, this is everything. This is the entire, even if it's furniture or anything which is, so smaller furniture ones are mostly charged off to P&L because they are smaller ticket items. But larger ticket items are capitalized, which is capex in nature, which is in line with our accounting policies.
And at what run rate you would depreciate the 2.7 crore that you would have invested in a store? And this would include the rental deposit, or it will not include the rental deposit?
No, this doesn't include the rental deposit. This doesn't include the rental deposit, and the depreciation is during the useful life of assets or the defined straight line method prescribed rates in the Companies Act.
It's fair to assume that this whole investment is depreciated in the next 5 years once invested in?
No. Our useful life is approximately 9 to 12 years. Our lease terms are in fact 12 years average.
Okay. And what is the deposit amount, rough, if you could, for the store?
Between rentals of between 3 to 6 months. There are different deals at different sites, but max is 6 and minimum is can go as low as 1 or 2 months. But
On per store?
3 to 4 months.
On per store, what it will work out to?
In terms of absolute number or in terms of...
Absolute number.
Difficult to say because our rentals in metro markets and tier 2 markets are very different. I think it's better to look at average of the number of months of around 3 to 4 months. So on a per store basis, just try and give a number to you. So max around 20 lakhs.
Okay. So basically your capex is about, let's say, 3 crores per store.
So we don't look at it that way, but yes, if you add other things and assume that deposit is not coming back, yes, it's 3 crores.
Yeah, but that's any case invested into. So 3 crore per store, you are revenue generation of about 7 crore. As of now, looks like 7.5 crore. Okay. Thank you very much, sir.
Thank you.
Thank you. Our next question is from the line of Niket Shah from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. Rahul, just 2 questions. First on growth, and maybe this is not the right quarter, or within delivery, if you can just give us some sense of how much of the growth is coming from the existing customers versus new customers.
So look, we get also a large part of business from aggregators, right, where we don't get the data, so it's very difficult for me to give a number there. But on our own app business, we are seeing repeats almost every 3 months from our customers.
So would be 60% of your revenues in delivery is from existing customers, or 70%?
Yeah, but if you look, we're also growing, right? So that repeat rates is very difficult to calculate right now. But what you can do is look at these numbers and maybe come back to you separately.
Sure. And the second question was on the delivery part of the business. Is that done by, wherever there is an aggregator, the aggregator does the delivery, or you have the delivery guys on your payroll to do it?
No, aggregators do the delivery.
Sorry?
For their business, aggregators does the delivery. We don't fulfill that.
And for the one which directly comes to your app, you do it?
Partially we do. Partially we also tied up with third-party logistic providers.
Okay. And any thoughts on changing the model to something more the way Jubilant does, or you would like to keep the way it is?
So it will evolve like it has been evolving for last, 5-6 quarters. We'll see what is the throughput, whether the delivery boy economics make sense. For Jubilant, it makes sense given their higher volumes. At our volumes right now, maybe it doesn't. So, it's an evolving game. We will try with few, we'll not keep in all. I don't have an answer right now. There's constant working done on various models. We already have few delivery boys, right? So that's ongoing. But that's all dependent on how the business scales up and what is the economics of a delivery boy in your own setup.
Got it. And one more question, if I may squeeze in, on the rating part of it, which my colleague also asked. So just wanted to know, on the app, you rightly said it's 3.8, but we see a stark difference, right? So either there are people at 5 and either there are people at 1. What is the major grievance that people who are rating at 1 have, essentially? Is it with the product? Is it with the packaging? Is it with, what is the complaint that they have, essentially?
So most of the time, it is about cold food. We have not seen much comment on packaging, or we have not seen much comment on food, but most of the time it is on cold food, and that's when the view on how do you repackage it in a manner, how do you come closer to the customer so that the delivery time overall as reduces. Those things are working on.
Okay. Got it. Thank you so much.
Also on rating, the ratings on our own app are upwards of 4, right? So it is there are different channels on which the demand is serviced. So I'm not worried about ratings. I'm only seeing it improving over last 2-3 quarters. despite the growth in our overall sales numbers.
Sure. Perfect. Thank you so much, and I'll come back to you.
Thank you.
Thank you. The next question is from the line of Prafula as an individual investor. Please go ahead.
Hello, Rahul. Am I audible?
Yes.
Yeah. I have two questions. First is, do you have any plans to leverage the app with Jubilant?
No, very early to comment on those lines, sir.
Because if you look from a customer perspective, I mean, he will end up having so many apps for every time he wants to order a separate food. So eventually, a lot of people are talking super app and all those things. So the standalone apps, how scalable they are? That is my larger question.
Okay, yes, you can argue that, but our belief is a bit different. I think India is a very large market. Both dining and delivery are very, very underpenetrated. The share of organized market is very small, and we are living this on a daily basis, right? And that's why some of these numbers that you see is what it is. Our own app downloads are going up. We are currently approximately 3 million downloads on the app. Despite the fact, and we adding almost 1 lakh download every month, despite the fact that the dining business was not there, right? So I think yes, it might feel that why would people have multiple apps, but some of the levels of brand have been doing that constantly, right? And given the repeats that we have between both dining, delivery, and the loyalty program, I think it makes sense and it provides a good value proposition for the customers. Are we at a level that some of the other larger companies or food tech companies are? No, but can we grow at a larger pace than industry? I think yes, that can happen, right? So I'm looking from that perspective, sir.
Okay. And my second question is regarding the fundraising plans you have. What is the idea behind that?
Look, so historically, we have not raised a lot of capital to grow this business, right? If I look at cumulatively 15 years, we have raised approximately 450 odd crores, out of which, on net basis, paying all the debt that we have cash of around 40-50 crores. So overall, it's only 400 crores that we have raised, out of which 200, if you have known our business in the past, we would have spent on acquisitions and investments like International, Johnny Rockets, Toscano, all these. So frankly, this Barbeque business is built only on 200 crores. And whatever expansion that we have done in our network is all flowing from the operating cash that we generate on a annual basis or a quarterly basis, right? During pandemic, obviously that has been impacted because of the restrictions of dining, and that has led to some operating losses also in this quarter. We have also done operating losses in the first half of last year, though we recouped a large part of that in H2, right? So our idea is that there is no point in stopping the growth. So you should have some capital for growth. And even though you have a couple of quarters of not optimal operating performance, your balance sheet should be strong enough to have adequate cash to take care of that. And that's the prime idea of raising capital. When we did our IPO, we did it for a specific purpose of repayment of debt, and a small portion was also for capex. But at that point of time, we could not have budgeted for second wave, right? And then second wave came. So it's better that you have a stronger balance sheet and then you don't compromise on growth opportunities, be it in your core dining business or be it in your delivery business.
Okay. Thanks, Rahul.
Thank you.
Thank you. The next question is from the line of Manish Poddar from Nippon India AIF. Please go ahead.
Yeah. Hi, Rahul. Thanks for doing the work. So few questions. First is, if you could probably help me understand, what % of the network is now open?
So we would have approximately 70% of our outlets operational. But when I say 70%, some of these are not operating beyond 4 p.m., some not operating beyond 9 p.m., some are closed on Sundays. There is no consistent rule across the country, and we are present over 80 cities, and the rules change by districts also.
So how have you taken this? When you say recovery is 61% in July, how do you tabulate that?
So when we say 61%, we have taken the revenue of the company, consolidated revenue. Sorry, 61%. No, it is 86% in July, right?
It is. So when I'm looking at only dine-in, let's say dine-in.
Okay. Yeah, so dine-in. So we have taken dine-in revenues of July 19, which is FY20, and compared this with 42 crores that we did in dine-in in July 21. So that's how.
So that will be full day versus 4 p.m. with the same 70% outlet open.
Yes. So
that is how it is, right?
The dine-in number in the month of July 19 was 421 divided by 0.61, which is 69 crores, which is their full operation. Yeah.
So let's say if the store was open full day, your revenue run rate would have reached where you were before. That's a fair understanding?
Yes, we should be doing that.
Okay. So, 2-3 more questions if I can. First is, let's say on the rental negotiation, have you done anything on the rental negotiation part, let's say for the full year?
So we are in constant touch. We have got certain waivers for Q1, and we are also discussing them for subsequent quarters. It is again very specific based on what are the lockdown rules, what sort of capacity we are operating at. So those discussions are going, and we are getting some rental waivers from our partners.
So any broad number, let's say at company level, is there a number, let's say 5%, 10%?
I guess early to say that we are still in the midst of some negotiations with partners, so it won't be appropriate to give a number right now.
Okay, and 2 more questions. First is on pricing action. Have you taken any menu pricing increase?
Very marginal, a couple of percentage points in both dine-in and delivery.
Okay, and one last one. So internally, do you look at let's say this metrics on a square feet level, or you look at it everything on store level only?
No, we look at it on store level. We don't look at it at square feet level. I think when we our philosophy on rentals are just when you're going inside, you don't overpay and try and come up with a number which works both for the landlord and for your business, right? That has been our philosophy right from the beginning.
Okay, got it. Great. Thank you.
Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Anivet Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. I have, just one question. How large is, the a la carte UBQ brand, and how easy or how difficult is it to scale, given that, you can do much more and product punches can be far quicker and better in that brand?
So, of our total business on delivery, around 70% comes from Barbeque in a box, and the balance comes from UBQ a la carte.
That's around 20%.
30%, yeah.
Okay.
So almost 6 crore per month on the current numbers, right?
Yeah. Okay. And from a scale perspective, is there focus to grow that? Is it positioned towards mid markets? What is the positioning, and how easy or difficult is it to scale? Because I'm guessing, after a BBQ box, people will not maybe, try and repeat it in a certain point of time. So is that cross-selling happening on the app? Is there a focus to scale that, or not a focus area it would come?
So there are 2 things there. One, along with your Barbeque in a box, you also get some a la carte orders. That's one. Secondly, a la carte orders also come in at a single meal price point perspective, right? So our Barbeque in a box is pretty much good enough for 2 people, and that's the feedback that we're getting from our customers. And when there's a single a la carte consumer, that's when he prefers barbecue UBQ offering. And some of our signature dish, like your Kaju spice potatoes or your American corns, so they do very well on a la carte business. So I think the positioning is more about one specific item that I want to have in the Indian cuisine segment, be it a kebab or be it a starter. I would order from that. But otherwise, if I'm ordering for a group of people, then I largely go with Barbeque in a box with an additional a la carte offering from UBQ.
Okay. And is the a la carte you towards metro or not necessarily?
No, not necessarily. It is pretty much similar profile.
Oh, fine. Thanks.
Thank you.
Thank you. The next question is from the line of Vishal Punmia from Nirmal Bang. Please go ahead.
Yeah, thank you. Thank you for the opportunity. So, I have a very small question in terms of understanding the product a little better. The question is related to the kind of menu items we have. Are those menu items made entirely from scratch, or do we also have arrangements with companies in terms of getting ready to cook or ready-made gravies, sauces, etc.? And if not, can we basically in the future try to have such arrangements which will basically help your management of inventory in a much better way? Are we open to that as a company going forward?
So we have been driving standardization of our inputs, raw materials over the last 2 years, and a large part of portfolio is already moved towards that standardized portfolio, wherein you get the base gravies and base marinades all done, and they're finished at the outlets, and a very small percentage of those are still under R&D stage. So
okay.
Yes, to answer your question, we are moving to that direction anyway.
Okay. So, for example, even Jubilant has a product which is basically your Chinese sauces or even North Indian gravies. Are those also a part of your portfolio, or is there some other players who you would be venturing with?
So we evaluate all options available in the market, and based on the pricing, quality, our need, what the supplier can supply, we take the best one which is possible.
Got it. Thank you. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today. On behalf of Ambit Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.
Thank you.